Welcome to another episode of the Multifamily Collective. This past week, I had the opportunity to connect with Robert Pereira, founder of ARC Multifamily Group. Robert is a real estate industry veteran with over 2 decades of investing and operating experience. In addition to managing capital and structuring deals, Robert has personally managed over $120 million of construction and over $450 million of value-add residential real estate projects since 2008. Robert has led ARC Multifamily to acquire over 2,000 apartment units in the Southeast United States. He earned an undergraduate degree in engineering in 2002 at the University of Waterloo and an MBA in real estate and finance in 2008 from the Paul Marriage School of Business at the University of California, Irvine. He currently serves on the advisory board of the UCI Paul Marriage School of Business Center for Real Estate. Robert and his family reside in Newport Beach, California. Now, this was a well-rounded conversation, mostly with the through line of what is happening in real estate, what has happened, what is happening, and what will be in real estate as we move forward into the next cycle. So some of the big takeaways for me is how ARC has successfully navigated a challenging market since it started, whenever that might have been, let's say 36 to 48 months ago, how they've successfully navigated that from that point in time to now, and how local representation is really crucial for a successful real estate asset. You have to have local expertise on the ground. The other thing is interest rates and the impact of buying and selling strategies in real estate today. We all know that we've been through a very tough interest rate environment. The interest rates are starting to relax, and so that is creating all kinds of opportunity or potential opportunity for investors on a go forward. So I would, as is tradition, ask you to grab your favorite beverage. For me, it's the Onyx Eclipse blend today, and I'm very excited about bringing this conversation to you. Please enjoy. Robert, welcome to the show.
Thank you, Mike. Looking forward to it.
Yes, and this is admittedly, it's a little bit of a round two. We had a little bit of a technical error on the first run, but that's okay. Such is life. You adapt and you go for it again, right?
100%. Always great to talk to you. So if I get a second opportunity, I'll willingly take it.
Excellent. Well, I know last time we kicked off, we were sort of moving from a macro down to a micro level as it relates to the current business climate and certainly opportunities that are presenting themselves in the current business climate. Certainly there are some potential headwinds that we're navigating, but it seems like the ice is starting to thaw, so to speak. So from your perspective, if you're thinking macro landscape right now, what are you observing out there in the marketplace?
You know, I can tell you that I think that, so ARC has been around now for 4 years. And we started while it was a period of low interest rates and everything was making money. So it was very hard to buy, very easy to sell. And our first asset went full cycle. We typically have a 5-year business plan. But our first cycle went 15 months and exceeded our 5-year numbers as far as exit price, as well as candidly NOI growth, just hyper growth between late 2020 and early 2022. Between 2021 and 2020, end of 2022, early 2023, we were able to get a couple of assets through relationships that, despite being a really tough market to buy in, we got good value. And one of the assets is called the Blakely in Pendergrass. It was such a large asset for such a young company that it took a lot of our capital raising throughout the 2022 year to buy that asset. We bought it in phases. It really gave us an opportunity to not only grow as a company, but also avoid the bad buying that I think largely was taking place in late 2021 through 2022. So as interest rates were starting to climb a little bit, but still pretty compressed, and cap rates were also very compressed, there was just a lot of irrational exuberance, I felt, in the market on the part of buyers. And sellers naturally looked at that as an opportunity.
That's a good way to put it.
Yeah. And so by the time we got into 2023 and had taken down the Blakely and very successful with that lease up, it was our biggest asset, 420 units in suburban Atlanta. We found ourselves in a climate where our last 4 acquisitions, we did 2 in 2023 and 2 in so far too in 2024 have been really, really good value. Fixed rate debt, you know, positive leverage almost day one. Um, Still solid rent growth in Class B, Class A, and Class B assets. Two of them I would classify as Class A. Two of them as Class B. We're in tertiary markets, so there's not a lot of competition, and we have really benefited. Solid income growth already, well ahead of our 5-year plans, and I'm hoping for more of that in 2024, the last 3 months that we have, and into 2025. As while we've seen interest rates start to come down, I think that there is going to be time before we have, you know, just larger competition, institutional competition. And so I think that for prudent buyers that are local to the market, we have local people on the ground in all of our markets between Georgia, Alabama, and Tennessee. And now we're actually going into the Carolinas in 2025. We're excited about opportunities to continue to buy. And from a looking at things macro wise, from the point of view of a seller, we have some assets that we bought in 2021 that are already economically, as far as the business plan, ready to go full cycle. We're waiting for interest rates to come down to be able to leverage that opportunity and sell them in what we figure is a little bit more of an even market. Right now, I still feel like we've got more of a buyer's market than a seller's market.
So let's unpack that a little bit. Interest rates obviously coming down 50 bips. I think that was 2 weeks ago or a week ago on a Wednesday. Certainly that has some impacts that'll make in the space. What is that? And you mentioned we need it to come down even further before we execute our full cycle business plan. What else needs to happen? We obviously want them to come down, but are there other things that need to kind of come into alignment before you pull the trigger on things?
Yeah, great question, Mike. I will tell you that while we have been blessed to have bought through local, like I believe that having local representation for a syndication company is extremely important. We've benefited from our team being local, and we've bought in places where we've seen good rent growth because of less competition. There still is competition. There's been a lot of construction that was built in 21, 22, 23, delivery of new units under the lower interest rate environment, right? So there's a lot of new construction built, quality properties, but we do have markets that are definitely saturated. And what happened in 23 and 24 was the spigot on the construction side got turned off. You went from borrowing in the mid to high single digits to about almost mid double digits as far as construction debt. And so builders just couldn't make things pencil, and so put things on pause. So in 23 and 24, we've had record number of units in the Southeast that are getting absorbed, that have kept rents low, that have had to offer concessions to be competitive. And we've done a good job at that as our competition, but it's definitely delayed some of the value add, just because they've had to be prudent about making sure that they can, be profitable, us and other operators. As 24 turns into 25 and then 26, I think the fact that we will be past that absorption and in an environment where with lower interest rates, regardless of the economy, I think probably see a mild recession, but I don't think it's going to have a dramatic impact on rents. I think once we get to a point where we are back to being somewhat undersupplied, which I think is going to happen in mid to late 2025 and definitely into 2026, we're going to see solid rent growth again. So in the face of that, plus lower interest rates, we see an opportunity to start to exit stuff in mid to late 2025 and beyond.
That makes sense. It's I heard I won't be able to make attribution, but somebody said survive through 2025, and then 2026 will be the start of the engine, or potentially the start of a new cycle for most of the operators out there.
The line I heard,
it's kind of made sense to keep some cash on the sideline.
100%. The line I heard in 2023 was survive till 25, heaven in 27. And I heard that from a mortgage broker friend. Yeah. I thought that sounded rich, but it looks like it's coming true. I think we're going to see some really solid years for sales in 26 and 27.
Do you, if you feel compelled to talk about this, some of the markets that seem interesting? I was watching somebody just a couple of days ago talking about the sort of the disconnect that's happened, like peak rents hitting around March or April of this year. And there's been a steady decline in rents. These are market specific. This is not broadly speaking. They were speaking about Austin at the time. Austin is 85% occupied across the market. Rents have come down quite a bit. The point that you just made about construction, there's been a ton of supply that's come into the marketplace, but it's shaping up to present opportunities.
Yeah.
Are there markets where if you're willing to share, that you're thinking about beyond, say, where you're at today?
Yeah, I mean, the last 4 assets we've bought have been, everything we bought has been below replacement cost, but we've really seen some solid discounts in 23 and 24. I think that some markets definitely have seen softness in rents, but I do think that in general, most MSAs are undersupplied long term. Right, we're still catching up from where we're not building.
Yeah.
So near term, we definitely are going to have to work through some of that inventory in certain cities, Austin being one of them. Core Atlanta, where we don't own, but right in core Atlanta, they definitely have some oversupply. In tertiary markets, we've been able to keep our properties in the low to mid 90s occupancy wise, just because of the fact that we are undersupplied in some of those markets. But in general, I mean, the buying opportunity to buy below replacement cost quality product. At ARC, we've done a really good job of building solid property management and operations, so that we're very comfortable in the A and B space, and so that's what we're buying. So we're playing to our strengths, seeing opportunities. I'd rather go further out geographically but stay in that asset class than look at some of the really hardy product in the C class space. I think there'll be some really good discounts for those who are buying in the C space, but they also better know what they're doing operationally in order to be able to turn those things around. I think that's where a lot of mistakes get made, because newbies try and play in that space because it's more affordable, and it's also they look at the potential upside, but you have to really know your comps and make sure that you're in a position where you're like for like in what you're comparing your rents to, because otherwise your value add can turn sideways pretty quickly.
That is definitely true. I know let's say in the last 48 to 60 months, there was a tremendous amount of what you just mentioned happening in the multifamily space, and certainly operators that were getting in that I'll stop short of saying they had no business getting in, but they potentially didn't have really good mentors or guideposts to help them along in those transactions. As it relates to that and playing off of the value add, I certainly think on the heels of 07, 08, so let's call it 11, 12, 13, there was this big sort of push into the renter nation. A lot of people bought value add properties, meaning you could get an untouched asset. You could renovate 50% of the units, not renovate the other 50, put some stuff in the common areas, leave a little meat on the bone for the next buyer. That, I'm not saying that's completely played out, but it's largely played out. But there's an asset class, say 2010, 11, 12 vintage, that's probably ready for a refresh, maybe not a full-blown rehab, but is that a market that looks interesting to you?
Definitely. I think, we're looking with the last 4 assets we bought, they're all, 2 of them were newer construction, and actually one of them, was newer construction. The other ones were all 20 years old. So we were buying early 2000s. So we're looking at stuff right now that is probably late 90s and up. If there's an opportunity to buy newer, we will. But I think that anything from early 2000s to early 2010s definitely has opportunity to have the value add done. You've got things like cabinets have gone from dark to light, and then in some cases they're back to dark. But there's changes like that definitely just making small fixes like that can definitely have you appeal to the newer comparables. You trail the brand new construction by just a little bit, but you provide a product that's as close as possible to it. Amenities that don't exist maybe or didn't exist as much 10 years ago. Dog parks, more outdoor fitness areas, common areas that will appeal to the more of the millennial or the Gen Y are ones that these are people that
right.
are now coming of age in their 20s and 30s that weren't renting 10 years ago. And there's a lot of things at play there. There's also, when you look at family formation, it is getting delayed a little bit, and so there's a lot of, the mix of ones and
Yeah.
twos plays a role. Before it was like, okay, one bedrooms are not seen as ideal. Now, I think that there's absolutely a play for that, where people will be long-term tenants in a one bedroom, because it might be a single person or it might be a couple that is looking to rent, and and that's a perfect home for them. So looking at older product that needs a light, needs some light stuff done to it, common amenities, and then new amenities that weren't thought of 10+ years ago is absolutely an opportunity.
To speak to that point, I read an interesting article the other day, or at least I thought it was interesting, and it was I think it was the central theme was that Gen Y, Gen Z, both coming into the renter pool, just like you mentioned, didn't care about amenities, not amenities as we would believe they would, right? So like swimming pools, fitness centers, things of that nature, they don't really care about those things. But the article went on to say, even though they don't care about them from a kind of marketing perspective, there's still a sense that you need a pool, you need a fitness center, you need a dog park. And I'm just curious, your opinion as somebody that owns properties and potentially gets feedback through surveys or other mechanisms. What do you think about that? People don't care about the amenities.
Good question. So, I think it's location specific, but I think most people when they're looking for an apartment are looking for certain check the box items. It's kind of like the Starbucks coffee machine that you might have in the clubhouse. Someone may never use it, or they
Yeah.
might use it daily,
Yeah.
but they love to know that there's access to it. The ability to have,
Yep.
we put conference rooms and even individual workspaces in our clubhouses, because after the pandemic, we knew that there was a higher appetite, obviously, to work from home. And sometimes, if you've got two people working from home, in a 1 or 2 bedroom apartment, you might have someone that needs to go to the clubhouse to be able to get peace and quiet while they get their work done. So I think, when it
Yeah.
comes to things like swimming pools, in some areas we have weekend like pool use that's very rampant, and then we've got other complexes where we do have a pool and it looks nice, but it hardly gets used. So, it is location specific, but I think that people still want to have access to amenities, whether or not they're using them. I think you present a friendly clubhouse. It's got a nice vibe to it. I say even something as simple as having, when you walk in, if you diffuse a nice smell, it just gives people, it goes back to,
Yeah.
I think everyone loves the opportunity to go into a high end hotel as an experience. And I think the closer you can have, especially your A and B plus apartment complexes, resemble that, give people the feeling that they're on vacation while at home. I just can't imagine that it hurts you marketing wise. I think it's a big sell.
Yeah, I think you and I are on the same page. I think even to your point, even if I don't use it, I sure love to tell my mom that I live in a community that has a beautiful pool and a great
Absolutely.
fitness center and all these things. So, or my friends, I get to tell them
100%.
and brag about it. So
Yeah. And in fact,
there's value
it
for
goes,
sure.
it's even the fitness centers. There's this thing. Do we keep them open 24 hours? Do we have them cut off at 10 and open up again at 6? And on some of our complexes, they are open 24 hours, and others that they're open 10 to 6. And we will get feedback on the ones that are open 10 to 6 that, hey, I can't work out if I want to at midnight. And so, you might have 200 residents and one of them wants to work out at midnight, but that is feedback, right? So we try and be as accommodating as possible, because we
That's
just want to be able to reach as wide a net and really value each of our residents' wants.
Yeah, that's right. I Okay, so I want to switch gears a little bit. You have over 2,000 units now. I want to take us back for a second. You at some point you started as zero, or maybe you go back to the origins of your real estate career and bring
Yep.
us forward to today. But if you could lace in um, starting a property management company and building an infrastructure and scaling it to where you have today, and then maybe compare and contrast where you are today and what you think you need to put in place for future growth, because I imagine you're getting ready to hopefully ride a rocket ship in this up in this next cycle.
Absolutely. Yeah, no, we're at great question, Mike. We're at 2,300 units, and we've got another, as far as future development plus, like, so what's coming already on our roadmap between now and middle of next year. I would say will take us to a little bit over 3,000 units before we start to sell some stuff off, and then hopefully 1031 into even bigger and better opportunities. But we started 4 years ago. ARC started 4 years ago. My real estate investing career started in 2008 in the great financial crisis. I had finished business school in Southern
Yeah.
California, where I still reside, and with a couple of partners, got into we started developing or redeveloping dilapidated homes. We saw that as the a way for us to build credibility, start working with investors on smaller products. So we were, working with just a few $100,000 at the time. We would do a couple of homes at a time, scaled it up over between 2008 and 2019. Along with my two partners, we redeveloped and built new, including most recently, we were in luxury construction, building multi-million-dollar homes in Southern California. But we did about 250 homes. What it did is it allowed us to take our investor base from 200,000 to about $20 million. And when we decided to pivot from luxury construction, where we enjoyed doing it, it was profitable, but it didn't have the cash flow that allowed us to give even better returns to our investors, consistent returns and better returns that were tax advantaged. When we first told our investor base at the time, we probably had about 50 investors that we were moving over to multifamily. We didn't think we didn't know what the feedback would be like. It was like overwhelming. All 50 said, "Hey, we're in," and then they told another 50 at the time. So in the last 4 years, we've gone from 20 million to just a little over 100 million of investor capital. Very blessed, we're all very heavily invested in the company ourselves, capital wise. Myself and my one main partner are still the largest investors at ARC in that $100 million stack. But we have, we're very blessed with a wide investor audience of about going on 250 investors. Along the way, we started buying assets in the Southeast. We saw opportunity in Atlanta. Our long-term ambition is to buy throughout the Sun Belt. We're at 2,000 and change units, going to 3,000. And my 10-year goal is I'd love to be at 15 to 20,000 doors. So we've got a long way to go, both in equity raise as well as in infrastructure and everything else that we're growing at ARC. But very quickly, and from my past experience in home building, I knew that having local expertise was the key. And so when we bought our first apartment complex, we hired our first asset manager. He was local to Atlanta, where we had the complex. He took a flyer with us. He left a very successful, very large company to join ARC, and it's worked out very well for him. But he's been instrumental in the growth of the company because he came in asset management, and then as we started to acquire more assets, we heavily relied on his expertise, both from underwriting as well as just knowing the market, because he knew all areas of Atlanta and greater Atlanta into middle Georgia, North Georgia, like the back of his hand, having worked in it for 15 years. Along the way, as we scaled, we got so heavily involved with operations and the asset management of leading the third-party management companies. We worked with some really great third-party management companies, but we also realized the amount of work that we were doing, while still having to deal with the middleman as far as regionals and whatnot in third-party management, gave us the thought process of wanting to hire in and start our own property management company, which we did earlier this year. So ARC is the name of our holding company that buys the assets. We've got a property management arm that we started earlier this year that's just called Axia by ARC. Axia, throughout this year and into early next year, will be taking each of our 11 assets and growing in-house. So we're going to be fully vertically integrated. And then along the way, we've just picked up the right mentors. Someone like yourself has been a mentor to us for going on multiple years now, and we've got other industry veterans that have done it. I call it. I say the quickest way and the most smooth way to go from 2,000 units to 20,000 units is to have just titans advising us on how to avoid the pitfalls and what to do infrastructure wise, operationally, to accelerate growth.
Yeah, that makes sense. It's if you can avoid all the pitfalls, avoid all the mistakes, the pace that you can accelerate that growth certainly picks up because you're not you don't get a flat tire on the way, so to speak.
Absolutely.
I'm interested. So if you're thinking out into the future in 2025, and I know we've touched on a lot of this in getting into different markets, are there what if you were looking at markets broadly speaking and you see the positive fundamentals for certain markets that you want to get into, are there markets that you're just like, no way, no how, not even at the right price am I going in? What are those fundamentals that you tend to look at where you just shy away from something altogether?
Great question. I will tell you that we're looking to avoid markets that don't have job growth. We're looking to avoid markets that are probably very easy
Mm-hmm.
to find. Um, I'm not afraid to go wide. Eventually, we've got offices right now in Atlanta and in Newport Beach, California.
Mm-hmm.
So we absolutely have an appetite to go west and scale and really kind of copy what we've done in the southeast, in the southwest next. Arizona, Nevada, Colorado, Utah are four states that have they're more landlord friendly and they cater a little bit more to the value add. Some more than others, but we're definitely interested in those markets and are looking to bring on people in acquisitions first, and then after that, asset and property management to do the same thing as what we're doing in the southeast. In the southeast, we're going to expand into the Carolinas in 2025. Nashville will continue to be a growth market for us. But really, it does boil down to buying. We want to buy in the path of progress, where we think that there's going to be continued job growth,
Mm-hmm.
family formation that's going to allow for, or others say household formation. So we're going to see continued population growth in these areas that's going to continue to drive rents and put us in a position where we know that 5 years from now, the assets that we own are going to be even in better shape than as far as the demand for the product than it is today. We know that we've got solid tailwinds, then it's just going to make it that much easier when we do the value add. So I'd rather wait or go wide for the right opportunity than feel forced to deploy capital in a market that I don't feel comfortable about. I won't name the specific markets that we're avoiding, just because I know there are
Sure.
buyers that buy there, and I don't want to sound judgmental, but we're definitely there's some markets where we just feel like it is too rough, where we just don't feel like we can add enough value, and where we're not necessarily going to attract the kind of resident that we're looking for that can pay that premium. So we're very careful about underwriting conservatively for a winning outcome. And if we lose a deal because we have been too conservative, I've told my team I'm okay with that. I'm not okay with being too aggressive and feeling forced to buy something and then regretting it because when we knew ahead of time that it probably wasn't a perfect buy. If it's not a great buy on the way in, I'd rather wait and something will come 3 or 4 months later. It inevitably does.
That makes sense. I want to key off something there that, as you were speaking through that, the word discipline came to mind for me. And I'm just curious, for you, have you always been innately disciplined, or did something happen in your sort of your career track where you weren't disciplined and you're like, you think you learned a really powerful lesson and now it's like, I don't compromise on the discipline as it relates to, especially on the buy side of multifamily?
Absolutely, I'd love to tell you that I'm the most disciplined man in the world always. I've gotten more disciplined with time. I've been at this now 16 plus years, and I've been spanked along the way. By decisions where I went against my gut. Never so much. I've never in 16 years, every investor that's worked with me, now 250 strong, has always made money. Very proud of that track record. I've not always. I've sometimes had to write a check when I was in the residential world if a project didn't do well. But it's taught me a lot. It's like stick within your buy box, make sure that you have really competent people around you. I'd rather my take today is I'd rather pay for the expertise of just A players on my team that are advising me and working alongside me. I'd rather pay the price of that than making an uninformed decision and buying an asset that when I don't have the right expertise that I then either have to work through or have to unwind, because that's always going to be more expensive. That, it's I'd rather have that expertise. So the discipline that I have today really comes from having a lot of very informed opinions, and then ultimately I do make the final decision with the way we're set up right now at ARC. So it is great in that I can listen to the experts and then go with my gut. But those expert opinions are so focused and so local, with ownership. For us, we give out we have equity compensation to the company. So I tell people, you're investing alongside our investors, and it comes, those shares come directly from
Yeah.
our ownership. So that we don't, the employees love the fact that they're getting that buy-in. It's typically our senior people. But with that, there
Mhm.
is an onus to make sure they're making the right decisions. They know that I don't mind being cautious, and waiting.
You hit on a really big point there. I think one of the keys to business is really aligning incentives. Everything kind of boils down to incentives. And if you have your incentives aligned, right, throughout the stack, the human stack, as well as the cap stack, you'll probably have a pretty successful investment. It's when
Absolutely,
those incentives get out of balance.
100%. Yeah, and part of it is just making sure you have daily, weekly, monthly accountability. That you really are taking care of the assets well. Um, and over time, it absolutely pays off very handsomely.
Let's so sort of bringing this to a close. If you were advising, let's say the entrepreneur that's coming into the real estate space, they don't know a lot, but they know enough that they need to talk to gentlemen like yourself. What would you sort of say to them to help them set the stage for a successful career? So maybe it's the top one or two or three things that, hey, just pay attention to these things and be
Yeah.
true to them in order to be successful. What would you say?
It goes back to what you were saying earlier, Mike. Having people that can advise you, that have been there, to help you avoid pitfalls. Yeah, I think for
Mm-hmm.
someone who, whether young or old, if they want to get into the multifamily space and take a long-term approach to it, where they're trying to do it over a decade at least. Okay, not, hey, I'm trying to get rich in 2 or 3 years. By and large, that doesn't happen, right? In fact, the opposite is true, where you could lose a fortune in 2 or 3 years if your cycle is that short. If you take a decade approach and say, hey, what can I do in 10
Yeah.
years? Because 10 years in, if you're successful, it's not going to stop. It'll keep going, right? People always need a place to live. And
Right.
so I would tell someone who's just getting
That's
started,
right.
get the right kind of mentoring. And then for your first couple of deals, I would find an established group that is willing to let you participate on the equity raise side. And we do that at ARC with new people, where we have them come in and raise equity alongside us and be part of our team. It's a great way to work with an established player, understand their playbook. Um, you know, there's a lot to be learned from being alongside an experienced operator. The opposite happens too often, where someone takes a course or listens to a quote unquote guru, and then the next thing you know, they're either buying it themselves or they're partnering with a few other inexperienced people. And like you said, the people who are buying in 2020, 2021, it was oftentimes a group of uninformed people with innocent motives, but
Mm-hmm.
without having that expert, that bought the wrong asset and now are in a world of hurt. So in order to avoid that, your first 5 years are probably going to be the toughest anyway. Why not get some wins under your belt by working with a proven
Right.
operator, build some track record off of them, learn with them, and once you've accomplished that, then to go on your own in maybe year 3 or year 5, it still gives you a lot of stretch, but you've avoided the pitfalls in the early going,
That's right.
and you've built. I mean, there's just a lot to be gained, but be careful who you partner with, right? It's like, make sure that they've got track record, they've got skin in the game, proven wins. Ask them, like, grill them, and if they can't handle the grilling, run, right? So, and I think that's something that doesn't get done enough. You're right. We often, especially in the world of social media, there's a lot of people pretending that they are doing a lot more than they're actually doing. But if you get past the social media and you actually, hit them hard with real questions, get some references, you'll find out, who's really got track record and credibility, and those are the people to align with.
Yeah, that all true. That is so true. I'm thinking back to my youth, and when I got into the real estate business, I was really fortunate to have an amazing mentor that did everything that you just said, and held me accountable. On top of that, once you buy the real estate, you have to certainly take care of it. You can't just set it and forget it, so to speak. So,
Absolutely.
all true stuff. Um, Listen, I always appreciate talking to you, having conversations with you. I absolutely appreciate the fact that you would invest some time for our audience. We have both listeners and viewers, and we're growing our audience every single day. And I think this will just bring value to them. And so, in the event that they have a question for you, where can they find you online or find out more about your organization?
Awesome. Thank you. The easiest way to get a hold of me is via email. It's Robert, Robert, at arcmf.com. That's arcmf.com, which is ARC Multifamily Group. And if they shoot me an email, say that they listen to your podcast, Mike, and they want to get more information on ARC, I'll add them to our prospective list. Happy to answer any and all questions, and if I can provide any help to any of your listeners, it would be my greatest pleasure.
Awesome. Well, we'll link that up in the show notes along with your name and a link to your website so that if people want to learn more on the web first before they gave you a call or shot you an email, we'll do that. But Robert, definitely appreciate it.
Likewise, Mike. Thank you.
Thank you.